Matt, I just want to show you what the merger arbitrage calculator is doing. So pretty much this is a project where if you have like different announcement dates for stocks that are being merged together, then the strategy is to go short on the acquirer company and then go long on the target company. And so I'm going to give you an example of two different deals that I'm looking at right now. So the first one I'm going to be taking a look at is this deal between Fox. So they're the acquiring company, and Roku, which is being bought by Fox. And this was announced on June 15th. So what I usually do is I'll go to Claude and I'll just ask it, tell me some details about the merger. And so a lot of mergers, what they'll do is they'll offer either cash or stock for the deal to go through. So in this case, I'm asking what's the offer, closing date, and probability of failure for the deal. So you can see Fox Corporation is offering $96 in cash and 0.96 shares of Fox Class A for each share that you own of Roku. So you would buy Roku stock today and then short Fox Class A stock. And then the ideal strategy is that you would hold these until the deal closes. So Claude is giving an estimate of the first half of 2027. And through more research, you can figure out what is a more likely estimate that the deal would close at, or whether or not you have some sort of information that it would take longer than expected. And both of these things will factor into the calculator and what your total return might be. So if I want to put this in the calculator, what I'll first do is I'll come over to here. I have AlphaVantage as my data source. And so this was the API key I was talking about. AlphaVantage is a real-time data like service provider for like equity research. And so you can use it for just stock data. What I'm using is this daily adjusted close. So what the calculator does is it finds the closing data for each stock going back, I forgot how many days I said it, and then it'll also get the closing data from the announcement date. So for this Fox and Roku deal, it'll start calculating the spread on, like June 15th, and then tell you what the return might be. And then it has all sorts of other real-time data, like if you're trading options or if you're trading just indexes, so like the NASDAQ 100, and then some other interesting like balance sheet and cash flow data that you can get for companies. And then even more like technical stuff going into like cryptocurrencies, or like if you wanted to build out a strategy for a customer, if they wanted to, if you're doing like financial planning, where maybe your client is buying gasoline for their trucks and you wanted to create some sort of model that will hedge against the price of oil in the future. So after I have my API key in here, what the calculator does is you can go in and then select the deal type. So I'll show you another example that I'll do after this is this deal right here, Vertex Pharmaceuticals acquiring Crinetics Pharmaceuticals. And so this deal is all cash. So Vertex is going to pay each shareholder of Cinerex $85. And then I'll show you how that works in the calculator. But for this Fox deal, they're paying cash and stock. So the target company is Fox. The target company is Roku. And Fox is acquiring them. And then the reason it's Class A is just based on what Claude said is right here, this exchange ratio. So if you own one share of Roku, then once the deal goes through, you'll own 9693% of a Fox Class A share. So I'll copy this, put it into the calculator. and then you'll also receive $96 for each Roku share that you have. And the announcement date was June 15th, 2026. And the expected closing date of the deal, like what Claude says here, is the first half of 2027. So I will just set this to sometime in June. And what I like to ask Claude is whether or not they see any threats to the deal closure occurring along the timeline. So this could also include something like, maybe Fox has an offer to buy Roku, but then Disney also wants to have an offer to buy Roku. So these are also like different factors that you can think about when you want to calculate what the probability of failure might be. And so what Claude is saying is that there might be some antitrust issues and some other regulatory fees that they had to pay in the future. And so in total, they estimate a range between 15 and 20% failure. And this isn't unique to some deals, but it's unique to this one for this example. And then deal cost. So this is for just unique situations where maybe there's a disclosure that like your brokerage might require you to pay some extra tax on a merger. Like for example, if you own the Roku shares, maybe you're a brokerage on Robinhood, or like I use Schwab. So like I'll go in here and I'll look up the stocks. Maybe for some reason your brokerage requires that you pay some additional fee for doing this deal, and you can put that information in there. And then once you fetch the data, it'll go through AlphaVantage and it'll get the current price for each of the stocks. So you can see Roku is the target, Fox A is the acquirer, and then how many trading days there are until close. So this is almost 1 year until closure. And then this is the number that you're going to be using to figure out your expected return for doing this arbitrage. So you can see it just summarizes the information again, and you can see we're doing a cash plus stock deal. And you need this information, like the price of the target at the announcement day, just to calculate the spread. And in total, it calculates that just by owning the two stocks. So if you just look them up, look it up here. So you can see, let's find the announcement date, June. Yep. June 15th, you can see there was a spike in the price. And that makes sense because, Fox is offering that they're going to pay $96 plus a portion of their own shares for owning Roku. And if you come back to the calculator, you can calculate what your expected return is going to be. And this is calculated by subtracting out any additional costs to make the arbitrage happen, including paying dividends out. So if you're buying Roku, if you're long on Roku and then you're short on Fox, you can see they have a dividend that is expected to be paid going forward. So if you're short Fox, then you'd have to pay out this dividend to the person that you borrowed the share from. So it subtracts out that cost of the dividend into your annualized and even just your current expected return for the deal. And so some other things that change this return include the probability of failure. So let's say maybe closer to the date of the purchase, it seems like there's only a 3% probability of failure at this point. So you can run this again. And sure enough, your expected annualized return increases just a little bit. And what this graph will show you is the price data Yeah, so this is going to show you 30 days before the announcement of the deal, all the way up to today. It's just a line chart of the price, and then it charts the spread. So I'll show you in the next deal where this spread is 8%, so it's pretty healthy. But in another deal, like this Vertex deal, here, I'll refresh this and then start it over again. So go back here. So CRNX is being bought for cash. They're being bought for $85 per share. And you can see if I look them up, yeah, CRNX, you can see because it's a cash deal, the price almost flatlines here, and it's flatlining around $85. So it's been trading between $83 to 84-ish, 83.8 per share. And the reason it doesn't go all the way up to $85 initially, like what the deal is outlining, is because there is that probability of failure. And so if the deal doesn't go through, then the price is likely to revert back to what it was before the announcement on July 7th. And so if it reverts back to that original price of $42, then that's your downside risk. And what the merger arbitrage is trying to capture is the spread between the current price of $83 and the announced final price of $85. So even though you're not making large chunks of money, like you're only making like $1.15 per stock that you own of Crinetics, some people might view it as risk-free. And then additionally, like it's a return that you don't normally get from like just buying the S&P 500 or like the NASDAQ 100. And like, let's fill out the calculator. So the announcement date was July 7th, 2026. And then I think I asked Claude when they expect the deal to close. Yep, so they're expecting it to close towards the end of 2026. Let's put that in here. And let's assign a probability of failure of 3%. So you can see again how many days until close, and it's an all cash deal. And it doesn't look like, you'd have to pay a dividend in this deal. And so you can see it's much lower, only 1.76% return if you had bought Crinetics right now and then the deal went through. But overall, you actually have an annualized expected loss just by owning the stock. So just by, running the numbers, you might think that purchasing it today at $83 is a good deal because you'll get paid $85 in a couple months. But based on the actual carry and ownership of the stock, and because there is like a probability of failure, your expected return could be negative. And so this is the line chart I was talking about, where it'll show you the price of the stock for the past 30 days. And then this red line down here is showing you the net spread. And so the net spread is what you would receive after all costs are factored into the calculation. And so if you look at all these deals, if you go through them, you can just put the ticker in and then put in whatever Claude says would be the expected close date and then the terms of the deal. So you can see like the deal prices, they're going to offer this much cash and then this much stock for each deal. Once you run all of these, you'll get a bunch of different gross spreads and net spreads for the deals. And what you can do after that is figure out, if you're looking at this table and it seems like, okay, there's a technology company, here's a pharmaceutical company, Vertex is also pharmaceutical. You have some like aerospace. So you can go through and see the diversity of where these deals are happening. So if you were to buy all of these, if you were to participate in each of these mergers, and like even like some of these, Some of these are, their returns are correlated. Like maybe Fox isn't the only company in this list that would be exposed to like an antitrust regulation. So if this deal falls through and you lose whatever investment that you had on this deal, then it might not be the only one affected. You know, like I can't think of an example in here, but like I guess like there's another. Yeah, so for these biotech ones, you have you have a biotech company here, you have another biotech company, and then even this one right here, Eli Lilly. Like if there's some new legislation that comes through that can affect all three of them, and you're invested in all three of them, then there is some more probability of failure assigned to those. And so what you can do is you can allocate how much you're going to actually invest in each one of these. So if you invested in this entire sheet, it was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 deals. You might want to put, you know, rather than putting 10% of your money in each one of these deals, you might put 30% in this one and then smaller amounts in the other ones, or whichever ones you think have a higher probability of success. So that's kind of what the calculator does. And yeah, if you ever want to talk more about investment stuff or the Series 66, then I'm more than happy to.